Welcome back to the deep dive. Today we are strapping in for something that on the surface looks like a rocket ship taking off, but when you look under the hood, might just be a very expensive combustion engine running on fumes.
Hmm.
We are talking about Virgin Galactic.
It is a fascinating case study. If you are looking at your trading terminal today, the date is Monday, January 19th, 2026. And if you're watching the ticker SPCE, you are seeing a lot of green.
A lot of green.
The share price is hovering right around $3.10.
Which, to be fair, is up about 50% just in the last week. That is a massive move. I mean, if you're a casual observer or maybe someone holding a bag from a few years ago, you're thinking, they're back. This is it.
It certainly looks that way. But the mission of this specific deep dive is to look past that green arrow. We want to look past the marketing gloss, ignore those beautiful artist renderings of future space planes, and focus on the one thing that actually matters for us as investors. Cash generation. We are going to apply a strict Graham-Dodd value investing lens to what is arguably one of the most speculative favorites in the market.
Graham and Dodd, the godfathers of value investing. They would probably have a heart attack looking at this balance sheet, wouldn't they?
Oh, they might just close the book and walk away, but we're going to read it. We're going to go through it.
Okay, so the conclusion we're teasing right up front, it's a bit provocative.
It is. While the stock is trending up right now, the data suggests we might be looking at an incinerator of capital rather than some hidden gem.
An incinerator of capital.
As we'll discuss later, this looks a lot like a quarter selling for $1.
A quarter selling for $1.
Yeah.
Okay, so let's set the context before we get into the ugly numbers. Why is it moving right now? If the fundamentals are so suspect, what is driving this 50% rally?
It's a perfect storm of technicals and optics. First, you have something called a gamma squeeze.
Let's pause there. We hear short squeeze all the time, but define gamma squeeze for the listener who isn't, a full-time derivatives trader.
Sure. So back on January 14th and 15th, just a few days ago, traders bought nearly 30,000 call options.
Wow.
That is a huge spike in volume. Now, when you buy a call option, you're betting the stock goes up. But there is someone on the other side of that trade, usually a market maker, who sold you that option.
Right. And they don't want to gamble. They're not in the business of betting.
Exactly. That market maker wants to be neutral. So when they sell you a call option, they have to hedge their risk. And how do they do that? By buying the underlying stock. As the stock goes up, their risk exposure changes. That's the gamma. And they have to buy more stock to stay hedged.
So it creates this feedback loop.
It's a feedback loop. Traders buy options, market makers buy stock, the stock goes up, which forces market makers to buy even more stock. It has nothing to do with business performance and everything to do with, sort of, market plumbing.
So it's a sugar high. It's artificial buying pressure created by math, not by actual revenue or profit.
Precisely. And the second factor is what I'd call the shadow of competition. Jeff Bezos's Blue Origin is launching their NS-38 mission in just 3 days on January 22nd.
Interesting. So when a competitor launches, it reminds everyone that space tourism is a real thing, and SPCE gets a sympathy bump.
That's exactly it. It puts the sector back in the headlines. But as we're going to find out, that comparison to Blue Origin is actually one of the biggest risks Virgin Galactic faces.
So the question we are answering today is this rally based on a real turnaround? Or is reality about to set in?
That's the core question.
Let's find out. We've got a lot to get through, so let's structure this properly. We're breaking this into 2 parts.
Okay.
Part 1, we'll cover the business, management, and financials. Then Part 2, we'll look at market sentiment, ownership, and the specific risks.
Sounds good. Let's dive into Part 1.
Part 1, Chapters 1 to 3, Business, Management, and Financials.
Chapter 1.
Business understanding.
All right, so let's start with the business model itself. I think for most people, the model seems pretty simple. It's like a super high-end airline, right? You build a ship, you charge a wealthy passenger, say $450,000, you fly them to space for a few minutes, they come back with a smile, and you pocket the profit.
That is the perception. That's the brochure. And, if that were the reality, this would be a very different conversation. But as of today, January 2026, that is not what Virgin Galactic is.
What is it then?
Currently, it is a capital-intensive R&D laboratory that just happens to have a very, very loud marketing department attached to it.
They're not really an operator.
They're not. You have to understand they aren't really operating a service right now. They are in a gap year, or more accurately, a gap few years.
This brings us to the Unity era. We should probably talk about VSS Unity, the ship that famously took Richard Branson to space. That ship is retired now, correct?
Yeah.
It is, and understanding why it was retired is, well, it's key to understanding why the business struggled to make money in the first place. Unity was a prototype. It was never really a commercial asset.
How so? I thought it was flying commercial missions. It was taking people up.
It was flying, but it wasn't commercial in the, let's say, the economic sense. Imagine running an airline where, after every single flight to Chicago, you had to take the plane into the hangar, strip it down, completely overhaul the engine, and inspect the entire structure for weeks.
So you fly once a month, maybe?
Maybe once a quarter,
Yeah.
if you're lucky. You can't scale that. It's impossible for margins. The marginal cost of every single flight was astronomical.
So they were losing money on every ticket sold?
Almost certainly. It cost more to fly the ship than they were making in ticket revenue. So retiring Unity was the right engineering choice, but it had a severe financial consequence. It turned off the revenue tap completely. The company is currently generating almost zero revenue.
Which means the entire company, all $227 million market cap, is betting on the next phase, the Delta class.
Correct. The Delta class is the savior. The entire investment thesis rests on these new ships being built right now.
And what's the promise there?
The promise is that they will carry 6 passengers instead of 4, which is a big deal. That boosts revenue by 50% per flight immediately. And crucially, they are designed to fly weekly. Management claims that with just 2 Delta ships, they can generate $450 million in annual revenue.
That sounds great on paper. $450 million is real money. But we need to do a moat check, because even if they build these ships, do they have a defensive advantage? Or is the technology itself kind of a trap?
This is where it gets really tricky. They have the brand, sure. Everyone knows Virgin. But a brand evaporates if you don't have a product to sell.
Fair point.
The real issue is the tech stack compared to the competition. Virgin Galactic uses an air launch system. You have this massive mothership that carries the spaceship up to altitude, and then it drops it.
Which is a cool experience. I've seen the videos. It's very cinematic.
It's a very cool experience, no doubt. But look at the labor involved. You need 2 pilots in the mothership, then you need 2 pilots in the spaceship itself. That is 4 highly skilled, highly paid pilots for every single flight.
4. Okay, and compare that to Blue Origin.
Blue Origin's New Shepard is a vertical takeoff rocket. It is fully autonomous.
How many pilots?
0 pilots.
Wow. 4 versus 0.
Exactly. In a long-term economic battle, the guy paying 0 pilots has a structural cost advantage that is just very, very hard to beat. You're starting the race with a heavy backpack. You have salaries, benefits, training, sick days. Blue Origin just has code.
And it's not just the labor. I want to bring in the macroeconomic picture here, too, because the sources mention a supply chain trap. We can't ignore what happened in mid-2025.
Right, the tariffs. In June 2025, the U.S. imposed 50% tariffs on steel and aluminum.
And these ships are not made of papier-mâché.
No, they are made of high-grade aerospace aluminum and titanium. I mean, these are the lifeblood materials of the Delta class. So back in 2021, when management gave us their unit economics, how much each ship would cost and how fast it would pay for itself, those numbers were based on 2021 prices.
And now?
Now, the cost to build the machine has skyrocketed. This means the payback period just gets longer and longer. If a ship was supposed to pay for itself in 6 months of flying, maybe now it takes 9 months or 12.
And when you are racing against a bankruptcy clock, that extension is terrifying.
It's everything.
Yeah.
It reminds me of that Warren Buffett quote, "In a difficult business, no sooner is one problem solved than another surfaces." They solved the prototype problem by retiring Unity, but then ran straight into a macro inflation wall.
That's a brutal reality check on the business model. Okay, let's pivot from the what to the who, the people running the show.
Chapter 2, Management Evaluation.
All right, let's pivot to the people making the decisions, the stewards of capital. The CEO is Michael Glacier.
Michael Glacier. He took over in 2020. His background is fascinating. He came from Disney Parks International.
Disney, so he knows theme parks, he knows lines and churros and creating a magical experience.
He knows experience. He knows how to manage a queue, how to price a premium ticket, how to make you feel the magic. And for a while, that seemed like a good fit. I mean, Virgin Galactic is selling a dream, an experience.
There was a but coming.
There's a but. We are in the build or die phase now. They aren't selling tickets. They are trying to build a factory and certify a spacecraft. They need a manufacturing wartime general. They need someone who knows how to navigate a supply chain crisis and the labyrinth of FAA certification.
Right.
One has to wonder if a background in hospitality is the right toolkit for a company that is, for all intents and purposes, a distressed aerospace manufacturer right now.
That's a really fair critique. It's like hiring a hotel manager to build a hotel. But let's look at their actions, not just their resumes. We always talk about skin in the game.
Yeah.
If the Delta class is going to be this massive success, surely the insiders are buying up shares at $3.10.
You would think so. I mean, if I knew my company was about to 10x because of some secret weapon we were building, I'd be maxing out my credit cards to buy every share I could.
So what does the data say? Let's look at insider activity from December 2025 and January 2026.
The data says zero. There is zero significant open market buying.
Nobody, not one person.
Nobody. In fact, it's the opposite. CEO Michael Coglazier, CFO Douglas Ahrens, and the Chief Legal Officer Sarah Kim, they all had shares vests recently, and what did they do? They sold shares to cover the taxes.
Okay, to be fair, selling to cover taxes is common. I don't want to penalize them for paying the IRS.
It is common, you're absolutely right, but think about the signal. If you truly believe the stock is deeply undervalued, you might pay the taxes out of your cash savings just so you can keep all the shares. Or, at the very least, you would sell to cover taxes and then turn around and buy more on the open market.
And they didn't do that.
They didn't reach into their pockets to buy any new shares, and more importantly, when the stock is down 99% from its highs and the people who see the blueprints every day aren't buying, I mean, that is the loudest signal you can possibly get. If the CFO isn't buying at 310, why should you?
That is sobering. And it brings up the issue of trust and their track record on promises.
It's a history of shifting goalposts, a real pattern. In 2019, they promised commercial service would start in 2020. That was a miss.
Yep.
In 2021, they promised 400 flights a year by 2023. Not only did they missed completely. They flew a handful.
And now,
Right.
what's the current promise?
Now, the promise is that Delta commercial service will start in Q4 2026. But just think about what that entails. They have to finish construction, do ground tests, captive carry flights, glide flights, powered flights, and then get full FAA certification, all by the end of this year.
It seems ambitious.
It's incredibly tight. We have what we call the Buffett buffer on our team, where we add 12 months to any timeline management gives us, especially in a complex industry.
So that pushes us into mid-2027.
At least. And as we're about to see in the next chapter, they might not have the cash to last that long.
Which leads us perfectly into the numbers.
Chapter 3, Financial Health.
Okay, this is the part that usually hurts. We call this the oxygen tank calculation. How much air do they have left to breathe?
Let's look at the most recent numbers from Q3 2025. They had $424 million in cash and equivalents.
That sounds like a lot of money to you and me.
It's a fortune. You could buy a private island, but not when you're burning money like a furnace. Their burn rate is approximately $108 million per quarter.
Per quarter. Okay, let me do the quick math here. 424 divided by 108. That's not even 4 full quarters.
Right. It's about 3.9 quarters. Statistically, without new capital, they are out of cash by mid to late 2026.
Which is right when they're supposed to be starting service.
Exactly. The timeline is razor thin. And this is why they did that debt restructuring back in December 2025.
Right, let's untack that deal. They called it a capital realignment. It sounds fancy, but was it a good deal for the company?
It was a desperate deal. Here's what happened. They repurchased about $355 million of their old notes. Those old notes only cost them 2.5% in interest.
It's cheap money. That's basically free money in this economy.
Very cheap. But to do that, they had to issue $203 million of new first lien notes. And the interest rate on those, 9.8%.
Ouch. So they quadrupled their cost of debt.
Effectively, yes. And it gets worse. These are first lien notes.
Explain that term for us. What does that mean?
First lien is like a mortgage on your house. It means the debt is secured by the company's assets. If Virgin Galactic goes bankrupt, these new lenders are first in line. They get the factory, the ships, the tools. They get to strip the company for parts.
And the shareholders.
The shareholders, you and me, get zero. Before this deal, the debt was unsecured. Now, the lenders have their claws in the actual assets. This is a classic distress signal. A healthy company does not borrow money at nearly 10% when they could have gotten it cheaper.
So they are paying credit card rates just to keep the lights on.
Right.
Let's talk about the light at the end of the tunnel, though. The promise. They claim the Delta ships will bring in $450 million in revenue and $100 million in EBITDA. Is that even plausible?
Let's do the reality gap math on that. To get $450 million in revenue, assuming a $450,000 ticket price, you need 1,000 passengers a year.
Okay, 1,000 people.
Which requires about 166 flights per year. If you have 2 ships, that's 83 flights per ship per year.
So one flight every 4-ish days.
1 flight every 4.3 days, nonstop. No holidays, no weather delays, no maintenance breaks. And remember, this is rocket science. Things break. This isn't a Southwest 737.
And what are they doing right now in terms of revenue?
The trailing 12-month revenue is $1.66 million, and the net loss is $292 million.
Wow.
To go from losing nearly $300 million to making a profit of $100 million requires a miracle of execution that has literally never been seen in the history of spaceflight. It's not just ambitious, it borders on fantasy.
Okay, we've painted a pretty bleak picture of the fundamentals, but the stock is up 50%. So let's take a break from the balance sheet and move to part 2 to figure out why.
Yeah.
Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
Chapter 4, market sentiment.
Welcome back to part 2. We've looked at the harsh reality of the business, the cash burn, the delays, but the stock is up. So let's talk about market sentiment. Ben Graham famously said the market is a voting machine in the short term and a weighing machine in the long term.
And right now, the voting machine is winning, hands down. The market is behaving emotionally, not rationally.
We mentioned the short squeeze earlier. How significant is the short interest here? Is it a big factor?
It's a huge factor. About 20.6% of the float is sold short. That means 1 out of every 5 shares available to trade is an active bet that the company's price will go down.
That is a very crowded trade.
It is, and it creates what we call a coiled spring effect. When you have that many people betting against a stock, any tiny bit of positive news or even just momentum from a gamma squeeze forces those short sellers to panic. They have to buy the stock to close their position and stop the bleeding.
And that buying just pushes the price higher.
Exactly. It drives the price up, which scares more short sellers who then also have to buy. It's a vicious cycle for them. So even if the company's burning cash, betting against it right now is extremely dangerous.
So you can be right on the fundamentals and still go broke.
Absolutely. You can be right on the fundamentals and still lose your shirt shorting a stock like this during a squeeze. That explains why the stock is moving up despite the terrible financials.
What are the professionals saying? The Wall Street analysts who cover this for a living, are they buying the hype?
They are mostly sitting on the fence. The consensus rating is a hold. Goldman Sachs is neutral, and they specifically cite the cash burn. Jefferies actually has a buy rating, but interestingly, they just cut their price target way down to $8.
So why hold? Why not sell if the cash situation is so obviously bad?
Because they're waiting to see if the Delta class actually exists. There's no revenue to model right now. There's no PE ratio because there's no ENO earnings. They are valuing a story, a narrative.
And until that story is proven false.
Or true. Until that story is proven one way or the other, they are just going to wait. It's essentially a binary option. It either works and it's worth a lot, or it fails and it's worth 0. A hold rating is the safest thing for an analyst to say in that situation.
That makes sense. Let's look at who is actually holding the bag here. Who owns this binary option?
Chapter 5. Ownership structure.
So who owns Virgin Galactic?
This is one of the most telling metrics, I think. Institutional ownership is only 13.5%.
13.5. That seems incredibly low. I mean, usually you see big, stable companies with 60 or 70% institutional ownership.
Exactly. You want to see the smart money pension funds, big mutual funds. The fact that they have largely exited the building tells you they don't see the long-term value here.
And the ones that are left?
The institutions that are left are mostly the big index funds like Vanguard or BlackRock who have to own it because it's in an index they track. They aren't actively picking it. They are forced buyers.
So if the smart money's out, who owns the rest? That's a huge chunk.
Retail investors. 86.3% of the company is owned by individual investors like you and me.
Wow.
This pushes the stock firmly into meme stock territory. It becomes emotional. It moves on hype and Reddit posts rather than earnings reports.
And those retail investors, those long-term holders, are facing a silent killer. Dilution.
This is the most painful part for anyone who's held this stock for a while. The company is surviving by printing new shares. We call it the dilution machine. Remember that reverse stock split back in June 2024.
The 1-for-20 split, yeah.
Right. They did that to prop up the share price so they wouldn't get kicked off the stock exchange. But since then, they've been selling shares almost constantly via at-the-market offerings. They sold $138 million worth in Q4 2024, another $23 million in Q3 2025.
And it's still happening.
It is. Just this month, January 2026, they filed to resell up to 68 million more shares.
I love the pizza analogy for this. Can you explain that?
It's the best way to visualize it. Imagine you own a slice of pizza. You think you own 10% of the whole pie. But the company needs money, so they don't bake a bigger pizza. They just slice the existing pizza into thinner and thinner slivers to sell to new people. Your slice gets smaller and smaller, even if the pizza stays the same size.
So give us the numbers on that slice. How much has it actually shrunk?
If you adjust for all the splits and offerings, the number of shares outstanding has grown 547% in 5 years.
Oh, that's brutal.
Meanwhile, the share price has dropped 99% from its highs. Investors are literally running up a down escalator. You are fighting massive inflation in the share count. Even if the company's total value goes up, your personal share price might stay flat or go down because there are just so many more shares now.
That's a tough pill to swallow. Okay, let's move to the risks. Let's put them all in one place.
Chapter 6, Risk Assessment.
We've touched on risks throughout, but let's formalize this. We need to do a circle of competence check. Investing here feels like it requires a PhD in risk management.
It does, and we can categorize the risks into 4 specific and very scary buckets.
Let's start with the big one, the one you can't really quantify. Risk 1, catastrophic.
This is the binary risk, the big one. Space is hard. If a Carnival cruise ship has a bad day, maybe the buffet gives everyone food poisoning, or worse, the ship sinks. It's a tragedy, lawsuits happen, insurance pays out, but the Carnival brand survives.
Right, people still go on cruises.
People still go on cruises. If a Virgin Galactic ship has a fatal accident with passengers on board, the brand likely dies that day. There is no recovery mechanism for a luxury space tourism brand that kills its customers. You can't model that risk in Excel. It is a zero on the roulette wheel that comes up more often than people think in the aerospace industry.
Okay, risk 2 is competitive. We talked about Blue Origin, but let's go deeper on what you call the frequency gap.
Right. Blue Origin is flying next week on January 22nd. They are operational, they are fully autonomous, and they cross the Kármán line, the internationally recognized 100-kilometer mark for space.
Which Virgin doesn't do, right? It's at the point of contention.
Virgin typically hits 80 to 86 kilometers. That's recognized as space by NASA and the FAA, but not by everyone internationally. Blue Origin goes higher. But the real risk isn't the altitude, it's the pocketbook. Blue Origin is backed by Jeff Bezos,
Who has essentially infinite money from Amazon.
He can sell $1 billion of Amazon stock in an afternoon to fund his hobby. Virgin Galactic is maxing out its credit card to stay alive. One has a sugar daddy, the other has a debt collector. In a price war or a delay war, Bezos wins every time because he doesn't need the profit. Virgin needs the profit just to survive.
That is a stark difference. Okay, risk 3.
Interest rate risk, or WACC. That stands for weighted average cost of capital.
Translate that for us.
It basically means how much does it cost us to get money? Because they are now borrowing money at nearly 10%, their WACC is around 10.9%. This means any project they invest in, building a new hangar, buying a new tool, has to return at least 11% profit just to break even on the cost of the money used to build it.
That's a high bar.
It's a very high hurdle to jump. Most mature companies have a WACC of maybe 6 or 7%. Virgin is sprinting with weights on its ankles.
And finally, risk 4. Regulatory.
The FAA. Getting certification for the Delta class is not guaranteed. And remember that cash runway, they have less than a year of cash. If the FAA finds a software glitch and says, we need you to pause for 6 months while you fix this, that delay could be fatal.
They just don't have the cash buffer.
They have no buffer to absorb a regulatory delay. It's a race against time, and the referee can stop the clock whenever they want.
We've covered a lot. We've seen the gamma squeeze, the cash burn, the 4-pilot problem, the dilution. Let's bring it all together for a verdict.
Chapter 7, Conclusion.
The verdict. After all this, where do we land?
The verdict is, I think it's pretty clear. We're looking at a company with a powerful dream. I mean, space travel is the ultimate dream, but it's attached to a nightmare of a balance sheet.
Well, let's play devil's advocate for 1 second.
Yeah.
What is the bull case? What is the royal flush scenario where this actually works and investors make a fortune?
The bull case is that the Delta ships finished construction this year and worked perfectly right out of the box. That demand is so high they can charge even more than $450,000 a ticket. That they execute a smart capital raise during the squeeze to fill the bank account, and they manage to survive until cash flow turns positive.
So everything has to go right.
If everything goes right, this could be a multi-bagger stock. It could go to $10, $20, no question.
But the bear case, the value investors view.
The bear case is just looking at the facts on the table today. Negative cash flow, no current product, paying 10% interest on debt, insiders are selling, not buying, massive ongoing dilution, and a competitor with deeper pockets who is already eating their lunch.
It brings us back to Warren Buffett, doesn't it?
It always does. Rule number 1, don't lose money. Virgin Galactic, as it stands today, violates rule number 1. This is speculation, not investment. There is no margin of safety here. You are paying $227 million for a company that might not exist in 18 months.
So the final metaphor, what are we looking at?
We are looking at a quarter selling for $1. And the pocket has a hole in it.
A tough visual.
It is. The rating from our perspective is clear. Avoid. Or, if you are lucky enough to be holding it during this rally, sell into strength, take the money, and run.
There you have it. A sobering look at a high-flying stock.
And just a final provocative thought for you to take away. We talked about the gamma squeeze, that plumbing issue where options volume drives the stock price, completely disconnected from the business. It makes you wonder. How many other companies in your portfolio are moving today, not because they sold more widgets, but because some traders on a screen bought a bunch of call options?
A good question.
It's a reminder that sometimes the market price is just a reflection of leverage, not value.
Something to chew on. That's it for this deep dive into Virgin Galactic.
This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.
See you next time.